Welcome to Trading Made Simple. My name is Zara, and I'm so excited to get your trading journey started. In this first episode, we'll break down the essentials of trading and explore the different types of securities and derivatives. Whether you're new to trading or want to sharpen your skills and deepen your knowledge, you're in the right place. Today, we're starting at the very beginning, so let's dive in. Let's start by addressing the fundamental question: what exactly is trading? At its core, trading is the act of buying and selling financial assets with the goal of making a profit. These assets can vary widely, from stocks and bonds to commodities like oil or gold, and even currencies like the US dollar or the euro. The idea is to buy something at a lower price and sell it at a higher price, capitalizing on price movements in the market. For example, let's say you buy shares of a tech company like Apple at $150 per share. Over time, if the company performs well and its stock price rises to $180 per share, you could sell your shares and make a profit of $30 per share. This is a very basic example of trading: buy low, sell high. But trading is not just about making money, it's about understanding the flow of markets, managing risk, and developing a strategy that fits your financial goals. Trading requires skill, knowledge, and a solid understanding of the market forces at play. In simple terms, think of trading like a game. You enter the market when the price is favorable and sell when it has moved in your favor. But unlike most games, there are many factors that influence the price of an asset, such as market sentiment, news events, and even government policies. And here's an important point to understand: timing is everything. Knowing when to enter the market, and perhaps more importantly, when to exit, can be the difference between making a profit and incurring a loss. For example, let's say you buy oil futures at $70 per barrel, and the price of oil rises due to geopolitical tensions. If you sell at $80 per barrel, you can make a profit of $10 per barrel. But if the price drops to $60 instead, you could face a loss. The timing of when you buy and sell can significantly affect your results. Now, let's take a deeper dive into the types of traders and trading styles, because not everyone trades the same way. When it comes to trading, there are a variety of styles and approaches, but broadly, traders can be categorized into two main groups: short-term traders and long-term investors. Number 1, short-term traders. Short-term traders, like day traders, focus on making quick profits by buying and selling financial assets within a single trading day. They capitalize on small price fluctuations, often executing dozens or even hundreds of trades in a single day. This type of trading requires constant monitoring of the markets, quick decision-making, and a deep understanding of short-term price movements. For example, a day trader might buy shares of a company like Tesla when the price is $200 per share, early in the morning. By mid-afternoon, if the price has risen to $205, the day trader sells, making a $5 profit per share. It's a small gain, but if done repeatedly throughout the day, it can add up. Day traders often use technical analysis, studying price charts and indicators like moving averages, relative strength index, and candlestick patterns to predict where prices might move next. This style of trading can be high risk, but also offers the potential for high rewards. Number 2, long-term investors. On the other hand, long-term investors might hold assets for years or even decades. They believe that the value of an asset will appreciate over time, regardless of short-term price movements. A long-term investor in stocks, for instance, might buy in a company they believe has strong growth potential and hold onto them as the company's value increases. Let's say you invest in Amazon stock, which has been growing steadily over the years. You buy 100 shares at $1,000 each, believing that the company will continue to innovate and expand. After 5 years, Amazon stock has risen to $2,500 per share, and your 10 shares are now worth $250,000. This kind of long-term investment strategy requires patience and the ability to ride out markets' ups and downs. This approach usually involves a lot less trading and relies heavily on fundamental analysis, looking at the financial health of a company, industry trends, and macroeconomic factors. The goal here is to ride out short-term volatility for long-term gains. Of course, there are also swing traders who hold positions for several days or weeks, looking to capitalize on medium-term trends, and position traders who adopt a long-term strategy but focus more on larger market cycles and less on short-term fluctuations. Understanding these different trading styles is key to determining what fits your personality and goals. If you prefer quick decisions and are comfortable with risk, short-term trading might be for you. But if you want to take a more relaxed approach, long-term investing might be the better fit. Now, let's dive deeper into the most common types of securities you can trade. Securities are essentially financial instruments that can be bought and sold. They represent an investment in something, whether it's a company, a government, or an asset. There are three main categories of securities: stocks, bonds, and exchange-traded funds. Number 1. Stocks. A stock, also known as equity, represents ownership in a company. When you buy a share, you're purchasing a small part of that business. If the company performs well, the value of your shares can go up. You can also earn dividends, periodic payments to shareholders from the company's profits. For example, if you buy 100 shares of Coca-Cola at $50 per share, and the company pays a dividend of $2 per share annually, you would receive $200 in dividends every year. If the stock price increases to $70 per share, you could sell your $100 shares for $7,000, making a profit of $2,000 plus the $200 in dividends. Stocks can be a great way to build wealth over time, but they come with risks. The price of stocks can fluctuate significantly based on a company's performance, market conditions, and even external factors like political events or economic downturns. For instance, when the pandemic hit in early 2020, many stocks plummeted in value as companies struggled to adapt to the changing economy. Number 2, bonds. Bonds, in contrast, are debt securities. When you buy a bond, you are essentially lending money to a company or government. In return, you earn interest over a set period, and at the end of the bond's term, you get back to your original investment. Let's say you buy a US Treasury bond with a 3% annual interest rate. If you purchased a $1,000 bond, you would earn $30 each year in interest. At the end of the bond's term, you get your initial $1,000 back. Bonds are generally seen as safer than stocks, especially government bonds, because you're guaranteed to get paid back unless the issuer defaults. However, because they are less risky, they also tend to offer lower returns compared to stocks. Number 3, exchange-traded funds. ETFs are a way to invest in a diversified portfolio of assets such as stocks, bonds, or even commodities, but without having to buy each individual asset. ETFs trade on exchanges like stocks, and they can be a convenient way for traders and investors to gain exposure to entire markets or sectors. For example, if you want to invest in the tech sector, but you're not sure which individual stocks to pick, you could buy an ETF that tracks the performance of tech companies. One such ETF is the Invesco QQQ, which tracks the performance of companies listed on the NASDAQ 100, including Apple, Microsoft, and Amazon. By buying the ETF, you're indirectly investing in a wide range of tech companies, spreading your risk. ETFs are also useful for investors who want to gain exposure to global markets or specific sectors like healthcare or energy. For instance, you could invest in an ETF that focuses solely on the energy sector, like the Energy Select Sector SPDR Fund, which includes companies like ExxonMobil and Chevron. Each of these securities has its unique characteristics, and understanding them is crucial for building a trading strategy that suits your goals. What are derivatives? Now, let's talk about a more advanced concept in trading: derivatives. These are financial contracts whose value is derived from the price of an underlying asset. In simple terms, when you trade a derivative, you're not buying or selling the actual asset itself, but rather a contract that tracks the price movement of that asset. The most common types of derivatives are futures and contracts for differences. Number 1, futures. A futures contract is an agreement to buy or sell an asset at a predetermined price on a specific date in the future. Futures are used for a wide range of assets, from commodities like oil, gold, and agricultural products to financial assets like stock indices. For example, let's say you think the price of oil will increase in the next 3 months. You buy a futures contract to buy 1,000 barrels of oil at $70 per barrel. If in the 3 months the price of oil rises to $80 per barrel, you can sell the contract and make a profit of $10 per barrel. However, if the price falls to $60 per barrel, you'll incur a loss. Number 2, options. An option gives you the right, but not the obligation to buy or sell an asset at a specified price within a certain period. There are 2 main types of options: call options, which gives you the right to buy, and put options, which gives you the right to sell. Let's say you buy a call option for Apple stock at a strike price of $200, expiring in 1 month. If Apple stock rises to $250, you can exercise your option and buy at $200, then sell at the market price of $250, making a profit of $50 per share. But if the stock stays below $200, you don't have to exercise the option and only lose the premium you paid for the option. Number 3, contracts with differences. A CFD is a contract between a trader and a broker, where the difference between the opening and closing price of an asset is paid in cash. CFDs allow traders to speculate on price movements without actually owning the underlying asset. For example, if you think the price of gold will rise, you can enter a CFD trade on gold. If the price of gold goes up, you make a profit. If it goes down, you incur a loss. This can be done on a variety of assets, including stocks, commodities, and indices. Now, why trade derivatives? The main appeal of derivatives is leverage. Leverage allows you to control a larger position with a smaller amount of capital. For example, instead of paying the full price for 100 shares of stock, you could use a smaller amount of money to control the same position through a derivative. However, leverage also increases the potential risk. While you can amplify your gains, you can also amplify your losses. This makes derivatives a high-risk, high-reward trading instrument, so they require a solid understanding of the market and careful risk management. To recap, trading is the buying and selling of financial assets like stocks, bonds, and commodities with the aim of making a profit. Securities such as stocks, bonds, and ETFs represent ownership or debt in underlying assets, while derivatives like futures options and CFDs allow you to speculate on the price movements of assets without actually owning them. As you start your trading journey, it's important to understand these basic concepts as they lay the foundation for developing your own trading strategies. In future, we'll dive deeper into topics like technical analysis, risk management, and more advanced trading strategies. Thanks for joining us on Trading Made Simple. If you found this episode helpful, be sure to like, subscribe, and hit the bell icon so you don't miss future episodes. In the next episode, we'll explore CFDs in more detail and show you how they can be used in your trading strategies. Until then, keep learning, keep trading, and remember, it's not just about making money, but understanding how the markets work.